Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 213 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you into our world of financial markets and financial planning. So happy Thursday, Matt.
How you doing, partner?
I'm good. Back. Good to be back in the podcast saddle, so to speak, after being off for a few weeks. Had some things I was doing with the business and some other things that just had a conflict with the time we were recording the podcast. So it's good to be back.
I'm sure our regular listeners and viewers are going to love to see your face and voice and hear your voice.
Yeah, well, it's I got a lot of good content because I was just stocking away content for about a month there. So
Yeah.
hopefully we'll have some good stuff for people over the next couple of weeks.
Love to hear that.
So before we begin, as always, just want to go over the numbers for the month and the year of the major indexes that we track. And these numbers are as of the market close on August 9th. And this data is from YCharts. S&P 500 index down 2.6% for the month and up 16.4% for the year. The Dow Jones Industrial Average down 1.2% for the month, up 6% for the year. The NASDAQ Composite Index is down 4.3% for the month and up 31.1% for the year. The Russell 2000 Small Cap Index down 3.6% for the month and up 9.9% for the year. And the Vanguard All World X United States ETF down 3.1% for the month and up 9.2% for the year. 3-month Treasury rate sitting at 5.55%, the 2-year Treasury rate 4.79%, and the 10-year Treasury rate at 4%. So really, Matt, the first, I wouldn't call it major, but first moderate pullback in the NASDAQ tech-heavy index that we've seen all year.
Yep.
Obviously, it's pulled back 4.3% so far month to date, and it's still up over 30% for the year.
Yeah, it was interesting in the podcast several weeks ago. I think it was 2 weeks ago that you were not on. I did make a verbal comment to all of our listeners and viewers in the podcast that you shared during one of our investment committee meetings in regards to the seasonality of the year that we're in the presidential election cycle and how August and September usually go. So it seems as if this is playing out, at least on a seasonality basis, as you had researched and looked into.
Yeah, and I'll have some more info for listeners on that here in a few minutes. Moving on to big headlines and current events for the week. July jobs data came in, so the forecast was a little over 200,000 U.S. non-farm payrolls. The figure came in at slightly lower at plus 187,000. Unemployment rate was at 3.5% against a consensus estimate that the jobless level would hold steady at 3.6%. So unemployment rate actually fell by 0.1%. Next, kind of a little update on earnings data from Bespoke, Matt. So this was as of August 3rd. So last week, 316 stocks, according to Bespoke, reported earnings this week. 73% beat earnings, 64% beat sales, and more companies raised guidance than lowered guidance. But the average one-day change on earnings has been a big drop of negative 1.61%. And they say even stocks that have beaten EPS estimates have averaged a drop of 0.11%. So for some people, Matt, this might be a little confusing because it's like, okay, stocks are reporting better than expected. Why isn't the market going higher? Why aren't these stocks moving higher? And again, it all goes back to the fact that the market is forward looking, and we've had such a nice run up so far, really year to date, without much of any pullback that, I think that was the market saying, hey, earnings are going to be pretty good. And people are, essentially just probably profit taking at this point, right?
Yeah, in essence, the market was expecting, hey, the stock has run up, you better beat, right?
Right. And it's one of those things, right? Like buy the rumor, sell the news, right? So people are expecting, good news, so they buy it well in advance. And just in general, the pre-earnings optimism, at least in the United States, is pretty strong, regardless of what type of market that we're in. So the couple of weeks leading up to earnings, companies typically have a little bit of a nice run up, especially the larger companies that make up the S&P 500. So
Yep,
really not surprising that even though these companies reported really well, a little bit of a sell-off.
I agree. Yep.
Moving on to tweets, articles, and research from this week. Can we still call them tweets, or do we have to call them like X's?
It's funny. Nick and I had this conversation Aaron and I'm sorry, had a conversation about this in the podcast. We're calling them X tweets temporarily because we don't know
X
what to do.
tweets. Yeah, perfect. This was a tweet from Willie Delwich, CMT CFA, and this was back on August 3rd. And he tweeted a picture of the AAII sentiment survey. And he said that right now, for investor sentiment, there's the fewest amount of bears in 2+ years.
Wow,
So
that
again,
turned
just
quickly in 6 months, didn't it?
yeah, it did. And just like breaking it down simplistically, if you're new to the podcast, you're new to the markets. Bulls are optimists that think the market's going to continue to go up. Bears are pessimists think the market's going to go down, have a lot of worry in their head. So typically when we look at investor sentiment, it's kind of a contrarian indicator. So when there's a lot of bulls, everyone's really positive and hyped up about the market. Typically in the not so distant future, we get some sort of a pullback, and
Hmm.
vice versa. When everyone's extremely bearish, they think the world's going to hell in a handbasket. Typically, we see the markets run to the upside. So right now, there's the fewest amount of bears or pessimists that we've seen in 2+ years. And again, like what you were saying, this so happens, Matt, to coincide with weak seasonality. And what I mean by that is, you know, in August and September in any given year tends to be a little more weak than the average month in the S&P 500. But if you look at it in a pre-election year, which is year 3 of the presidential cycle, which we're in right now, August and September tend to be even weaker. So this isn't surprising to me that everyone is super optimistic right now because we're in the midst of a pullback. And I'm actually going to hop to my third item because this kind of coincides with this. And I know you guys have talked to this point on the podcast when I was out, Matt, but there's
Okay.
a tweet from JC Peretz on July 31st. And he says, if the S&P 500 is going to take a well-deserved break, this would be a perfectly logical time in the cycle for that to happen. And he
Yep.
shows on the chart of the S&P 500 and the seasonality for pre-election years. So the blue line is pre-election years going back to 1950 through 2019, and the red line shows the actual S&P 500 right now year to date, and it shows that for the next couple of months we could see some sideways chop, a little bit of a pullback. So again, these culmination of things that we're seeing right now would lead me to believe that the market's in for a little bit of a breather. And that does not mean, I don't want people to get that confused with me saying the market's going to sell off 10 to 15%. That doesn't have to happen. Could sell off 5%, could sell off 10%, could just move sideways. But with all the data that we have, I think a breather, or at least market rotation, sector rotation, some of the value oriented areas of the market start to pick up the baton relative to what happened in the first half of the year with these growthy techie names really leading the charge.
And this is why you listen to and watch the Independent Advisors podcast. We've been talking about this. You've articulated this in plain English for our listeners and viewers, Mark. Great job on that this week.
Thank you. Last thing I had, Matt, was kind of just an interesting one, and want to get your 2 cents because we've talked about this stuff on the show before. But it was a tweet from Unusual Whales, and this was back on August 2nd. So they track insider trading, so to speak, and especially with Congress people. So they said, Justin, Senator Thomas Carper is shorting the American economy. Thomas Carper bought $30,000 in ticker symbol PSQ, which is an ultra short QQQ index on July 13th. So again, just to break down a little further, The QQQ index is a NASDAQ 100 ETF, tracks top 100 NASDAQ names. And PSQ is a ultra short NASDAQ index. So when the NASDAQ goes down, PSQ makes money essentially, right? So they're betting on tech names, growthy names to fall. So they say he hedged / shorted in the past with great results in ticker symbol HDGE and SH and also PSQ. Wild. A sitting congressman is literally shorting the US. What are your
How
thoughts on this?
unpatriotic is that?
Yeah, I know, right?
I mean, that is mind-blowing.
Yeah, I don't know. I don't know how I feel about it because I like it. One side of me is like, hey, it's, kind of like a free market. You can kind of do whatever you want. But if you're working in the government and you're,
Representing the
placing
United States.
bets
You're representing the
against
citizens.
America. Yeah.
I'd be ashamed if I were him. Personally,
Yeah.
I think
Yeah.
it is shameful.
Yeah. It's interesting. Yeah. I have no idea. It's to me, it's kind of mind boggling that with as much regulation that we've had in this country, especially with the financial markets over the past decade, that this is still something that is hanging out there. But I guess it's also not super surprising because the people regulating would be regulating themselves essentially. And who wants that?
Yep.
So I will turn it over to you.
All right. So my first piece this week for listeners and viewers is my topic is why you should stay invested in the market over the long term and why it's important. This is a tweet by Seth Goldenmark on August 2nd. And this is what he said. And this is a piece from SoFi that he's showing. And I'll quote, if you invest $1,000 into the S&P 500 index 25 years ago, you'd have $4,927 today, a 393% return. If you sold out after a pullback and waited a week to get back in, those gains would have been cut by 60% into to $2,138. Quote, I can time a top and rebuy lower. No, you really can't. So Jenna will put up this chart for our YouTube viewers. This will be in our show notes and all of our social media sites, Facebook, LinkedIn, Twitter, etc. What it shows, Mark, again from SoFi, over the past 25 years, the effect of exiting the market the day after a 2% sell-off for the market move or worse, and staying out each of the time periods shown below in the chart. And again, this is based upon an initial investment of $1,000 using the S&P 500 returns before transaction cost. And when you look at these numbers, it's actually putting some figures behind why staying invested in the market over the long term is important. Take a peek at this, Mark. What's your thoughts on this?
No, it's not. It's not surprising to see this. It's interesting data, but
The
it just
longer
goes.
you stayed out, the lower your returns were.
Yeah, and that's what the interesting part about this is that you know especially in a day like today, Matt, where you have the news at your fingertips. Your phone is pretty much an extension of the human body, and you can get any piece of information you want within seconds. That influences people to make emotional based decisions pretty quickly. Whereas, maybe 20 or 30 years ago, it would be a slower process because people would read things in the newspaper. They'd see things on the evening news at 8 o'clock. And there was a larger barrier. There was more friction to being able to make trades in your portfolio. You had to call your broker. You couldn't just hop online really quick or on your
Yep.
phone and place a trade. So I think this information is more important now than ever, just because you can get any piece of information in the snap of a finger.
And act on it in the same speed.
Correct. Yeah, it's like
Yep.
it's gamified. Investing is gamified now.
Yep. All right, here's my next piece. Last week on the podcast, Mark, I talked about a Goldman Sachs piece of research that was forecasting no U.S. recession. 1 week later, JP Morgan's now on board with this. So I just wanted to kind of share this. This won't take long. JP's title of the research piece is U.S. The end is not near. But what they say is, and I'll summarize, quote, with Q3 2023 growth looking solid, we are no longer anticipating a recession in this calendar year. Recession risks are elevated next year, but we look for modest subpar growth. If inflation doesn't continue to ease, more Fed hikes and rising odds of a downturn will come back. Well, what happened this morning? Inflation data came in, and what happened? Came in softer than expected. If a year ago, we talked about this in the podcast a year ago, but most people were not expecting sub 4% inflation. It came in at 3.2 or 3.3% year over year this morning. And it's just interesting how you're now starting to see the pullback of, it was almost virtually talked in the marketplace that a recession was going to happen the second half of this year. And you're seeing the resiliency of corporate earnings, the resiliency of the American economy, and now everyone's stepping back from these recession calls. Just want to throw it out there. Any comments you'd like to share, Mark?
No, I just think, going back to our conversation with Ryan Detrick, I mean, them and Carson have been in the camp all year that we're not going to get a recession. And that was definitely against consensus, right?
Yep.
Yep. So I just want to throw it out there that, anyone can be right about the economy, anyone can be wrong about the economy, but more often people are wrong about the economy. And look, like JP Morgan is a massive American institution, right? And there's some of the brightest minds in this country that probably work for JP Morgan, right? And now they're changing their tune, which I actually give them credit for, because most of the people in our industry, they say what they think and there's no deviating. They will defend that and die on that hill that I still think a recession's coming. I don't think a recession's coming. The market's going to fall by 20%. We're going to be in a bull market for the next 2 years. So I actually give them credit for changing their tune, because I think that's something that you have to be open to in our industry. Is you have to be open to the fact that, okay, you might be wrong. What am I going to do to correct that? What's the new data that I have at my disposal? And then I make a new forecast, or I make a new form a new opinion on something, right? So, yeah, most people wouldn't do what JP Morgan did. So I actually give them credit for that.
Well said. My last piece this week is from Ryan Detrick. And, the topic of this for me is this. We had a large one-day drop last week. It was on August 2nd, Mark. What does history say about this? So this was what Ryan said. First 1% decline after more than 2 months without one for the S&P 500. Just happened today. How much should we worry? Doesn't look like you should worry much. Since 1980, 1 year later, higher 26 out of 27 times and up on average 14.8%. I have to throw out the compliance disclaimer. Past performance is not indicative of future results. We are looking at historical data, but by no means is this indicating that the market's going to be higher 1 year from now. But it is nice to look at history, in my opinion. So Jenna's going to put up this chart for our YouTube viewers. This will be in our show notes. I'd recommend our traditional podcast listeners to go to our social media site to take a peek at it. Again, what are you going to see here, Mark? You're going to see 27 data points going back to 1985. And we've been in a low volatility environment now for several months. And with this small rise so far in volatility, it might make people think, oh, this is it. The market's going to be turning down. But when you look at this, the average return 6 months later in these 27 data sets is about 6.5%, a little bit better than that. And 12 months later, a little bit shy of 15% higher for the S&P. So I just found it interesting. I wanted to share that because you talked about seasonality earlier in the podcast. It wouldn't surprise me as well to see, sideways chop down. To what magnitude? You and I both don't know. But I do think that as the year goes on, I do think the investment environment overall, when I look out 6 months, 12 months, is still friendly waters. But you have to continue to invest for your risk tolerance, your goals, and objectives. This is a market that you want to have time in, not try to time it.
Yeah, I agree. And I think, we're almost getting back to that point, Matt, that familiar point where people are going to start to be nervous to put money to work because we're getting closer to all-time highs and the market's already ran almost 20% this year, and how can it go higher? And they start to play that game. Whereas, a year ago, if we were having this conversation, it was the market's going to keep going down. So it's like the goalposts are always moving, and we're getting to that point
Yep.
now
Yep.
where people are going to be nervous to put money to work because they think that we're due for another bear market. So,
Well, here's the other side of it. If you're an individual that's under allocated to risk assets, i.e., equities, guess what? You're starting to get some better pitches right now. Okay. And it wouldn't surprise me if the pitches got a little bit better as August goes on. And so the question is, are you going to take some swings or not? And that's just what I'll leave it at that point.
yeah, yeah. And I'm not, I actually think that if we didn't get a little bit of an increase in volatility right now and we didn't see some weakness in some of the areas that have been performing really well this year, that would be more concerning to make my ears perk up than if we, did get the weakness like we're seeing, right? Because
Yep.
it's earnings season. Volatility is typically a little higher around earnings season. We talked about seasonality and where we are in the presidential cycle. So if those things weren't happening, my ears would be up and being like, okay, what's going on here, because then the market's not acting as I would expect or people would expect.
Yeah, I think the mesh
Um,
between your sentiment chart as well as the seasonality was great today. And my last comment for our viewers and listeners is I want you to think about sentiment to positioning a portfolio. And again, for our newer listeners, when people are very bullish, when I say positioning, their portfolio tends to reflect that stance or that position, which
mhm.
is why for our newer listeners and viewers, when people are really pessimistic about the market, they tend to be underinvested to risk assets, right? Which is why we pay so much attention to that data.
Right. And while you're talking, man, I'm just pulling up uh, another sentiment chart
Yeah, please.
because I want to see.
Well, as you do that, I'll just share this with our listeners and viewers. You can Google AAII. It's the American Association of Individual Investors. And you guys and gals can go onto that website and get all that historical data. It's one of the most widely utilized sentiment indexes in our industry, and they publish that data for free on their site. So I want to encourage you that if you have an interest on this topic, it's a good resource to start at. Turn it back over to you.
Yeah, for sure. I'm trying to find one here on stock charts, Matt, that shows how much equity exposure active investment managers have right now. Here we go. National
Oh,
Association of Active Investment Managers Index.
this is a good one. This is a good one.
So, uh, so this was as of last week. Um, the National Average Active Investment Managers Exposure Index was about 80 to 85%, it looks like, Matt. But the week before, it was up over 100%. So what does
Oh,
that mean? People were 100% exposed to the equity markets with leverage, right? That's what that means. Anything over 100 is people are gung ho, bull, all in. We're using leverage, we're borrowing money to get higher returns. And now it's kind of dropped back to the 80 level, which is fine. But anything really over 70 makes me think, hey, where are we at in the cycle? What is sentiment like? What is the market doing? Are we due for a pullback? Are we a little extended here? Because
yep.
we've now spent since the beginning of June, active investment managers have had over a 70% exposure to equities. So just throwing that out there as well, that it might be time to see that pull back a little bit again when we're talking about sentiment.
Another good indicator. I like that.
So, all right. Well, anything else, Matt, before we leave it there for this morning?
No, we're going to skip the financial planning topic of the week. We're going to be blessed later in August. I'm going to have Taylor on as our co-host, And so we're going to have a little bit more of a financial planning heavy portion later in the month of August, which I'm very much looking forward to. Besides that, we're on the tail end of earnings season. So you're going to, I think, see the news cycle and individual names start to come back down as we move past earnings season.
Yeah, great. All right, everybody. Well, thanks for tuning in to episode 213. Hope you all have a great rest of the week and a great weekend, and we'll see you next week.
We'll see you next week, everybody.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.